This is the third in our series about the Secure Act. I'm calling it Did You Know? Because there's a few changes that the Secure Act brought about for inherited accounts, and it's very important that you take a look at how this has changed. We previously talked about qualified accounts, including IRAs and pensions and that sort of thing. Today, I'm talking about inherited non-qualified annuities, specifically annuities and not other accounts, because annuities are classified by the IRS as retirement vehicles, even though they are funded with after-tax dollars. Now, spouses may still assume a non-qualified annuity as their own. This is the same as a qualified annuity or other IRA or pension plan. Eligible and non-eligible beneficiaries are handled differently. Eligible beneficiaries are spouses, as just discussed, or grown disabled children with a qualifying disability, or a sibling perhaps that is less than 10 years younger than the original owner. Non-eligible beneficiaries are everyone else. That will be grown children, grandchildren, nieces, nephews, or entities such as churches or charities. Now, if you're an individual, you can do required minimum distributions, RMDs, based on the life expectancy table the IRS provides at irs.gov. Even though the premium that funded the non-qualified annuity is after-tax dollars, the gains are taxable. So you can take a required minimum distribution based on your life expectancy. This is the only time where you will have RMDs on a non-qualified account. If you opt not to take the life expectancy route, you can take the money out over a 5-year period. This is the 5-year rule, meaning you can take 5 equal installments, or you could take one final installment at the end of 5 years, or any combination in between. You do have to decide whether you're going to use the RMD rule or the 5-year rule when you take possession of the inherited account. These non-qualified annuities will be taxed on a LIFO basis. Again, the premium that funded the annuity is your cost basis and not taxable. It's already been taxed. But any gains in the policy are subject to ordinary income tax. LIFO means last in, first out. So the gains will come out first. If you're using the RMD method, you could have several years of just pure gains coming out and 100% taxable distributions. Now, the 59.5 rule does not apply here. Usually, if you take money out of any type of retirement account prior to 59.5, the IRS will impose an additional tax liability of 10%. That doesn't apply here in the case of these non-qualified accounts, or even on the qualified accounts as discussed in the previous video. Because they are forcing you to take it out within a shortened period of time and at an earlier time than you might have, they don't also add that tax liability. Now, entities such as trust or other charities, things like that, only have a 5-year option. So you don't get the RMD life expectancy table or anything like that as an option. So it's very important, if you have your retirement funds or even non-qualified funds that are set aside for later that you want to leave on, you don't need to make a trust a beneficiary. You already have these built-in protections and these options created by the annuity vehicle, that if you make a trust a beneficiary, you limit some of the options you would have had. So if you have a spouse, it's very important that you just make them either the primary beneficiary or a co-owner of the non-qualified account. So they may assume it as their own. and have more options with the account. Or if you want a trust to own the annuity, make the annuitants the spouses and surviving spouse as a primary beneficiary. That way they can become the new annuitant and you don't lose some of those benefits. That concludes this edition of Did You Know About the Secure Act? On your screen there is the different ways you can get a hold of me. I'm more than happy to answer any questions that you have about non-qualified or qualified accounts and how the Secure Act may or may not affect your retirement plans. So I look forward to hearing from you. Give me a call.